Welcome, everyone. Thank you for joining us this evening or this afternoon, wherever you're tuning in from. We will be discussing IRR is not your friend. Stop relying on projected returns with Ryan Daigle of Flywheel Equity. So first, I'm going to give you kind of a brief of Verivest. We are a real estate investment platform designed to bring transparency and trust to middle market investing. Our mission is to create and enable the conditions to increase the speed of trust in the private market real estate investment space. And our goal is to help enable investors to direct capital to those sponsors and managers who can objectively demonstrate they are trustworthy stewards of the capital. So here is our sponsor directory. You can go ahead and search by a sponsor. You can search by MSAs. You can search by the minimum investment type. You can see sponsors' background checks within the last 7 years. And then you can also see their quarterly checks and connect directly through the site. So the requirements to be a member on our platform: you have to have no personal or business bankruptcies, no unfavorably resolved lawsuits, no regulatory sanctions, no felony criminal convictions in the past 7 years, and signed the Verivest Code of Conduct. And here's my information if you would like to connect and hear more about what we do at Verivest. And then I want to introduce Ryan. He is the CEO and founder of Flywheel Equity. He's a 20-year veteran of the software industry. His last role was as CTO of Durham-based fintech startup, which saw growth from 3 employees to 80 during his 6 years there. He's a full-time multifamily operator, and he is now an LP in over 700 units and GP owner in 80, with his most recent acquisition being in a 51-unit heavy value add in Greensboro, North Carolina. He is also committed to making real estate accessible to all investors through education and transparency. So I will hand over the floor to Ryan. And then if you guys have any questions throughout the presentation, feel free to add them in the chat and we'll get those answered at the end.
Yeah, so the title of this talk is IRR is not your friend. Stop worshiping at the altar of projected returns. So I'm going to be talking a lot about IRR here. My position is not that IRR is mathematically flawed as a calculation. It is more that as the most prominent projected return that most real estate sponsors will show you, it is a super flawed way of looking at or at making an investment decision about an investment, whether it's a real estate investment or some other type of investment. It's used all over the place. Obviously, my expertise is more in real estate, and that's kind of what we're here to talk about, is in the real estate space. So, I'll be hammering on IRR, but it's mostly a proxy for any sort of projected returns, and we'll go into that a little bit deeper. So, Brittany gave a good overview. I have a tech background. Right now, I'm a full-time multifamily operator, and really, Flywheel Equity is a boutique private real estate investment company that focuses on value-oriented commercial real estate. So right now, that means multifamily. It also means commercial short-term rental properties. It also means self-storage too. Anywhere where there's value to be found, that's really the lens at which we look through most of our real estate investments. We're still very high on multifamily, but the market is, it's pretty, I don't know if frothy is the right word, because we could still have 5 or 10 years ahead of us of this great run up, but it's definitely fully valued, I think is a pretty diplomatic way of saying that. So that lens, that search for value, is really what brought me to this topic, which is this 15% IRR. How many times have you seen this? It seems like everywhere you look in this industry, there's definitely a gravitational pull towards this one metric, and it's usually right around 15%, plus or minus 1-2% here or there. But it's like that seems to be the gold standard for what operators are going to put in front of you as an investor to say this is worthy of your investment. And I really just want to question that. I want to question that assumption, and I'll do so by way of example. How many times have we seen 15% IRR? Well, I just went to a couple different sponsor sites, and this is not to pick on any one sponsor. We see this investment looks pretty. It's got a pool. It's on the beach. Looks amazing. I mean, I would love to be an owner in this property. 15% IRR. Oh, it's 550 units. It's huge in Florida. All right, we've got another pretty big one in Maryland. I'm assuming it's not next to a beach. I see a nice fountain, also 15%. Okay, interesting. Austin, Texas also has a pool. Maybe everything with a pool is 15% IRR. Oh, no, there's this one too. Looks a little older, also 15% IRR, completely different area of the country. And here we have something that looks like some sort of medieval warship or castle, also a 15% IRR. Okay, that's interesting. It's, all these different assets, different sizes, different caliber, different areas of the country. They all show you a 15% IRR. Do you mean to tell me that all those investments you think have the same probability of hitting that number? It can't be. That they're all so different, right? That the range of outcomes from those investments is going to vary wildly, right? Just because they all show you that 15% IRR up front, trust me, whatever your final end of deal IRR calculated return, actual return is, those are all going to vary just by a huge, huge margin. They're all just so different. And this really tells me what I already know, which is that operators, we are tweaking dozens of numbers in our projections to try to zero in on this acceptable outcome, right? This 15% IRR, which has been trumpeted to investors as this is the gold standard of what you should be looking for. We've conditioned investors to think this way. We're backing into an outcome, right? And that, as an investor, that should set off warning bells for you, right? That's the last thing you want your sponsor to be doing, is backing into an outcome that they think will be acceptable to you. And really the flaw here is that the IRR is based on so many forward-looking projections that nobody in their right mind can know, right? What's the exit cap rate in 5 years and 7 years? What's the interest rate environment? What's the rent growth? What will the rent growth have been over whatever the hold period is? We can make assumptions and estimates, but even the most well-meaning sponsor is going to be wrong by huge margins, because those are super high leverage inputs into this huge equation that spits out what our returns will be. And the truth really is that on day one of ownership, all that work that you've put into projections, and I say you, kind of talking about on the sponsorship side, like as a sponsor, all that work that we put in, and that all that understanding that we have strived to come to about the property and its prospects, on day one of ownership, it's like a new chapter is beginning, and nothing that you did in the past as far as numbers has any bearing on what's going to happen going forward. Those projections are useless. Okay. It's all about reality from that point forward. And there's a quote, some general somewhere, manly looking guy, probably had a cigar, said, plans are useless, but planning is everything. And so it's not to say that the exercise of going through and trying to figure out what sort of value does a property have, or what does it have as an investment potential, that process is not bad. You have to understand what you're getting into. All that work is useful as far as your entry point into the project, but on day one of ownership, reality is going to hit you, and it's going to be a whole different ballgame. Okay, so I really just want to question the usefulness of these really far-looking projections, of which IRR I think is the most grievous. Well, the one that violates that the most. So by way of illustration, like Brittany said, I have a technology background. This is a concept that we have in technology, and I'm sure by now it has crossed many disciplines, but it's called the cone of uncertainty. And it's a visual representation of that maps over time of a project, again, from the software industry, like a software or some highly complex project, could be maybe building a bridge or something like that. On day one, you have the most uncertainty, you have the most risk, you have the worst idea or sense of what your final outcome is going to look like and what it's going to take to get there. Okay. And as time progresses and as you approach conclusion of that project or that investment in our case, the cone of uncertainty is narrowing, right? There's, as you reach the final point, the more you know about what that final point will look like. And so I think about this a lot, and I've brought this framework into multifamily investing. I think it's really useful to think about this representation as far as a multifamily or any sort of real estate syndication investment. You've got on, the day that you get the OM from the broker, or maybe that you put in an LOI, your uncertainty is huge, both to the upside as far as potential outcome and potential investment outcome, huge to the upside, and also huge to the downside, right? This is not just about IRR is unreliable in that it only projects or doesn't project enough of your downside risk. It's in general variable to both sides. Okay, so on day one, you think you're getting into something, the final results are going to vary by huge margins. If something says 15% IRR, look at almost any deal in the last 5 years, you probably exited closer to a 25% IRR or even 30%. The operators, if they knew on day one that they had a high chance of getting 35% IRR, guess what? They would have kept more of that project for themselves. Okay, it's not like they knew it and are just being magnanimous about it and wanting to share in all this value creation with you. No, that they did not know that it was going to perform to the upside. And similarly, in different climates or just different projects, right? Each of them are different. Your uncertainty, the downside is also very, very big on day one. And so this blue line here, that to me, I think is a representation of your day of close, the day that you purchase the property. You've gone through a due diligence process, and I think in the industry, we somewhat over glamorize it. You make it seem like you just know that property inside and out. You know everything about how it's going to perform over the next 1, 2, 5 years, right? That thing is yours already. You're like, you've had a mind meld with this property by the time you close on it because of what you went through in due diligence. Absolutely not the case. There's 98% of the timeline of that project still remains out in front of you. So even on the day of close, when there's the sponsor, we as sponsors try to project so much certainty about the project, you have progressed just a little bit through that cone of uncertainty. So there's really not a lot more comfort or certainty that you can really hope to gain when you're at that closing table. So, what's the solution? Do we just say, well, I guess IRR is useless, return forward projections are useless, I'll just go with the operators I like? Well, if you like me, yes. If you don't, no, there are other solutions that we have, and I'm going to propose 2 of them to you. And really the framework and the logic for what makes a good number, a good projection versus IRR, in my perspective, not a good projection, is that we want metrics that are based on knowable numbers, knowable inputs, right? If anybody comes to me and tells me they know what the cap rate's going to be in 5 years, that I'll call BS on that. You may have a good, an educated guess, but you have no idea. Trust me, 5 years ago, nobody would look and have projected where cap rates are today. And certainly that's going to be the case going forward. Certainly without any confidence, right? People may get lucky, but nobody can do that reliably. So really, we want to stop relying on forward-looking inputs and really have metrics that rely on inputs that are knowable today. Okay, they're not speculative, they're knowable today. And it seems like a bit of a contradiction. It's like, okay, how do I want to know what an investment is going to do 5 years from now? That seems like I need to be making some sort of forward-looking return projection. It seems it seems like there's a conflict there in what I'm trying to measure and how I'm going to do it. But I hope by the end of this talk that you'll have more confidence in these metrics that I want to talk about today, which are based on things that are, if not 100% knowable today, much more knowable, much more reliable today than something 5 years from now. It's about what we can control and can know versus what we can't. So the knowable versus the speculative. These are inputs that kind of fall in these 2 buckets, or examples of them. So things that are knowable: current rents for similar product, right? You can go out in your market, find comparables. Are they perfect? No, but we've extracted the time component out. And so we're saying today for this type of product, I can point to 5 other properties and I can tell you within a pretty narrow margin of error what current rents for this type of product would be. That is a much more knowable item than something like an exit cap rate 5 years from now. Okay. Initial financing, the terms of the initial financing, the amount of the initial financing, those are things you're going to know at the closing table. Okay. Renovation budget. This is, renovation budgets certainly have variable outcomes, but using what you know today, what the cost of materials are today, estimates that you can get from vendors today, right? Those, you've taken the time component out, there's still variability, but that is a thing you can know, hey, I'm budgeting $10,500 in interior renovation costs because I have 3 quotes and I already have a vendor selected, or even better, I have experience working in this market. I've worked with these vendors. I have a team in place. This is what I know I can execute on today. Doesn't mean that number is perfect. It just means you're basing it on much more knowable, non-time sensitive information. And then like-kind operation and expenses, right? So of this property in this market with this management team of this size, I know that a stabilized operational load is about 47%. That's what it is across my portfolio within a margin of error, 1 or 2%, right? These are things that we can, we don't need to make guesses or look to the future for. We can know what they are today. Again, it doesn't mean you're going to nail those inputs, but that range, that variability should be much, much narrower when you've taken out the biggest variable of all, which is time. Okay. Speculative stuff that I say beyond at a very high macro level and in a directional sense isn't worth looking at or relying on. The exit cap rate, the rent growth rates, future interest rate environments, things like that. It's just going to be so different than you think. So what metrics can we utilize that stay within these parameters of the knowable inputs versus ones that are too speculative? So 2 alternative deal measurements that we use here at Flywheel Equity, and this is not like these are things I've made up, right? These are industry practices. I just find them to be not very well known and really not talked a lot about by sponsors when talking to investors. And frankly, I think that's a disservice to investors. I have to assume that most of you that have the capability to invest in real estate projects like what we do and other sponsors do, you got to a position of relative success by probably being pretty smart and understanding the types of investments, either of your time or your money. And so we here at Flywheel really like to go against the grain and educate investors about why we think these things are different and have complete confidence you're going to be able to understand that. And even if it's not something that you roll out across how you do analysis, at least there's some more tools in your tool belt to analyze deals. And you start to get comfortable with something the more you use it. So I want to put this on your plate. I'm going to talk about these 2. This first section of the talk was kind of the concept, the logic behind these 2 alternative measurements and why I think they're better. This last part is going to go into the measurements, the metrics themselves. It has math in it, but it doesn't have like quantum math. It has like division math. So all of you are quite adept at that, and it should be no problem. So don't let your eyes glaze over here. So the 2 alternative metrics that I like are the unlevered yield on cost. I'm not going to say that again. Return on cost, ROC, is the much easier to say metric. It's the same thing. You'll see them referred to by their initials there, UIOC, ROC. In general, those are referring to the same thing. And then also the stabilized debt yield is the second metric. And the important thing about this is that both of these numbers are knowable on the day of close, or a week before, right? When you've got your finalized financing and projections and everything else. So that they're much more reliable as indicators of the investability and the value of that particular investment. Okay. So unlevered yield on cost, return on cost, this is my favorite metric. I think it really encompasses in one number a lot about the return and risk profile of an investment. And the calculation, once you understand what it's representing, is really quite simple, but it's a beautiful thing, and I don't see it used enough. So it's also very relevant for value add work. That's most of what we do. Again, like I said, at Flywheel Equity, we're very much value oriented so we're looking for things that may not have reached their full potential. And in this market, 90% of what I see brokers pitching is value add. At least it's labeled as value add, even if that means $22 of organic rent growth ahead of it, right? So you're being asked to view these investments through the lens of a value add investment. And so this measurement, return on cost, is particularly applicable to value oriented or value add investments. So let's get into what it is. How do you do it? Well, the unlevered yield on cost, I said I wouldn't say that again. The return on cost the calculation is quite simple. It's your stabilized NOI is the numerator, divided by all the costs that went into the project to get you to the point of stabilization. That includes the purchase price, includes transaction fees, and it includes CapEx, renovation costs, et cetera. Okay. Now you might be looking at this and like, well, Ryan, I thought we were only relying on knowable numbers and knowable inputs, and stabilized NOI, it's a value add project that could be 2 or 3 years out. Am I being contradictory to myself here? And I would say that's a reasonable position, but here's my defense of that. Stabilized NOI, I'm not asking you to project 3 years from now a host of inputs. What I'm asking you to do is, if your project is stabilized today based on what you know you're going to do as far as renovations, what you know those renovations are going to cost based on bids and whatnot that you've received today, and your rental income based on rents that you have comps for today, that stabilized NOI is really more of a measure of, hey, what would a stabilized product be earning me today? So I'm not asking you to project 3 years out for a whole host of things. It's just today, what would that project, what would that NOI be? And the inputs that get you there should be much more reliable than something 3 or 5 years out, because all those inputs are based on today's numbers. Okay. So I'm not asking you to do today's numbers and then add some sort of rent growth projection or escalation in there. It's really about today. What would that product be able to get you? And then on the bottom are the things that, like we already talked about, are much more knowable based on estimates and whatnot and experience that you have today. So my contention is that this is a much more reliable set of inputs into this metric. And so it makes the metric itself much more reliable. Never perfect. Obviously, I would never say that, but much more reliable. Also, these inputs are very much in the operator's control, right? So one variability we want to take out when we're looking at reliable metrics, return metrics, are the variability that time introduces. So we're trying to do everything based on today's numbers. So we're taking out the time component. The other thing too is what's in an operator's control versus what is not in an operator's control. In a value add or something like this, you obviously know the purchase price, that's under your control. Closing costs and fees, not so much, but renovations and execution, those are things that are in the operator's control, right? There are levers that the operator has available to them to tweak to make sure that they're staying in range, right? So there's an ability to, as the project is progressing, to kind of guide it within an acceptable range of outcomes. If you're looking at a metric that relies on exit cap rate or interest rates or rent growth, things like that, those are things that are outside the operator's control. So even if the project starts to sway one way or the other, there's no ability for your operator to really rein in the boundaries of that project, right? Those are macro trends that the operator doesn't have control over. This is another reason why IRR and all these other forward-looking measurements are not reliable, right? So there's the time-based aspect, and then there's the what is in our control versus what is not. And so this unlevered yield on cost compresses that time variability, and it also represents a lot about what is within the operator's control. So that's why I like it a lot. Brittany.
Yes. Okay. So we got a lot of questions just right now
Okay.
regarding this. So I just wanted to address them while we're on this slide. So one question is, do you take into account management fees in the denominator?
Denominator. So no, because that's part of the NOI as far as like, those types of management fees. And so we're not either the asset management. So I'm assuming we're not talking about property management fees. Those are definitely part of the normal expenses. So that's represented in NOI. If we're talking about the asset management fees that would go to operators, then I consider that to be part of the return, right? And so this is not really looking at the return profile at all. It's just looking at the performance of the property as an operational unit.
Thank you. And then one more while we're on this slide. Is the stabilized NOI based on current rent before renovations, or what? I think they meant, or what do you think it should be currently with renovations?
The latter, right? So this is, if I could snap my finger and have a unit that is renovated to the standards that my business plan calls for, what would it rent for today, right? What that product in today's market, what will it rent for? Now, that's not a 3-year projection. That's a projection of, I know I can go out to the market, I can run comps, I can walk other properties and say, this caliber of renovation is going to get me $850 a month. And so that's my input into the NOI thing. So it's what the stabilized / renovated product would rent for today in today's numbers.
Okay, thank you. One more before we move on, Ryan. Is the purchase price just the cash invested, or does it include debt? Seems that unlevered would be exclusive of debt.
So this includes debt. So it's the purchase price, right? So if you buy, and the second number the second metric that I talked about is called the debt yield. That will take into account leverage and debt. This number does not. Okay, and that's a good thing by my perspective, right? Because there's a lot of, I won't say funny business, right? But debt can be used to juice returns and really alter the return profile of a particular investment. And debt is a tool, that's fine. Like, you want to use debt in the right way to maximize your returns, but you also want to make sure that debt is not being used to obfuscate what might be a fundamentally flawed deal, but just because the current debt environment is so favorable, it might hide those flaws. And so between this number, which excludes debt, leverage, any of those things, and the other number, debt yield, those two things when combined should give you a pretty complete view.
All right, thank you. Well, yeah, okay. So he said, any chance that we have a recording? Yes, this will be recorded, and I'll let you have the floor again, Ryan.
All right. No, thank you. Thanks for the break. So this is a pretty simple calculation, but we'll still just run through an example real quick. This is a deal I bid on earlier this year. Lost the deal, so don't get too excited. But we looked at it was a $17 million purchase. At least that was going to be our offer. There were closing costs and reserves and a lot of CapEx. It's a pretty heavy value add project. That's why those numbers are pretty big. And it was about a $24 million total cost in on the bottom. We thought we could get it to 1.725 on the NOI. That brought us to a return on cost of 7.18%. Now, before I talk about, well, what's a good return on cost, right? Okay, that gives me a number, but how do I interpret that number? I want to just kind of look at return on cost and notice how similar it is to another metric, which is used, not necessarily a return projection metric, but another number that we see used all the time in this industry. What would happen if we took out our transaction costs and any of the value added costs of this particular equation? That would be this formula, NOI over purchase, which is the cap rate. Okay, so how to think about your return on cost is that it's really the stabilized cap rate, okay? What it took you to get to a stabilized point. It's measuring the same thing as cap rate, but cap rate doesn't take into what it's going to take to get it to the stabilized point. Cap rate is useful when you're buying something that's already stabilized, or useful when comparing like-kind things, like-kind assets, across markets or whatever. But the yield on cost is really just the cap rate plus your cost of rehab, okay? To say it another way, the delta, the difference between your return on cost and the current cap rate, the current market cap rate, is your risk premium. Okay, that's the additional risk measurement for buying something stabilized at market rates, plus the executional risk of your particular business plan. Okay, if it wasn't a value-added project, then outside the transaction fees, which usually are lower on bigger projects, and the renovation costs, that's just the cost of going in. That's just the normal cap rate. So I really like to think about the return on cost, the spread between your return on cost and market cap rates for that type of asset, as a risk premium. Okay, and this really unlocks a lot of different types of comparisons. Okay, so if my previous example had a 7.18% return on cost, if the market rate for that type of asset is 5.5, I have a 1.68% additional risk premium that I'm being paid for. When I say I mean an investor, whether it's on the GP or LP side, the investor in this type of project. That's additional return that I'm being given for taking on additional risk, right? Because there is additional risk. And this delta there is no one number that you have to hit. It's really about your particular risk tolerance. Okay, so I'm very comfortable with value add stuff. That's what I execute on. That's obviously like my necessary spread. It might be 150 bips. Whereas if you're a new investor, you want to have as low downside as possible. You just want to have a 6% cash on cash return for as long as you can. Then, you might need a bigger risk premium to get into a value oriented or value added sort of investment. So that's really the benefit. It specifically identifies the premium you're being compensated for in that particular business model. And that really tells you so much more than IRR. Okay, that's a much better metric for investors, not only because you kind of know what you're getting into, what kind of return you're getting into, but as far as a relative return, maybe is a better way to say it, relative to your peers and to market cap what you're getting into, but it also specifically quantifies what a risk premium is. Okay, so like I said, all of us as investors have different risk tolerances, and the return on cost at least gives us a number that now we can use to apply to our own situations and whatever that particular asset or business plan or sponsorship team is, that we can say, okay, well, this is quite a juicy delta, and I'm comfortable with these people. I'm being fairly compensated for it. Like, it gives us that number to work with. But there are some in this particular environment. These are some of the kind of milestones that I use when I'm looking at a project. Anytime I see something with 100 bips, 1% of return on cost premium over the market cap rate, that's pretty good. Again, in this environment, lots of things have been compressed. So, 1% on that return on cost is a pretty good premium. 150 bips, 1.5%. or more is really, really good. Anytime you see a project that has a return on cost with that kind of spread to the market cap rate, that can mean two things. One, that can mean, okay, you're being compensated a lot for whatever the executional risk of that particular investment is. It may also be a warning sign to you that there's a lot of risk inherent in whatever this specific investment is. So you really want to understand the story behind that investment before you go saying, 200 bips premium, that's great. Ryan told me that that means there's a huge amount of a risk premium that I'm getting. I'm gung-ho on this. No, it might be that, you know, you're building a CBD warehouse or something that maybe has huge, you know, execution risk or market risk associated with it. So really pair your risk premium with the business model as you understand it, and make sure that those two are aligned. And if there are any discrepancies, that you understand why there is a discrepancy between premium you're being paid for versus what that business plan is. By way of example, when you're looking at comparing across assets, if I look at an A-class stabilized deal, new build in Orlando, you're probably paying a 3.5 cap right now for those type of properties. But they're amazing properties. They look great. You've got white collar, you know, younger professional type tenants. Your average income might be 80K, 100K, right? These are pretty strong properties. Not a lot of downside risk there. But then you're looking at something in a secondary market here in North Carolina. Maybe it's value add. It's something that Flywheel Equity is doing. And you've got a 7% return on cost, right? You know, that's 350 bips of delta. I told you that's a pretty good spread. Maybe that's enough for you. Maybe it's not, right? That's not my call. All I'm trying to really impart here is that to give you a tool to identify what exactly that spread and that premium is. And from that, you can then use it to compare across your risk tolerance and the investments that you have access to. All right. I'm going to take a breather, and we're going to talk about the next metric, which is the stabilized debt yield. This is much more easily digestible because it's one measurement, and it's not necessarily, I'm not asking you necessarily to compare it to another metric and get a delta, and from that use that number, right? So when we talked about return on cost, what didn't that take into account? A very astute question identified it already. Basically anything about financing, right? Nothing about your financing was part of the return on cost calculation. And that's on purpose. We don't, because financing can distort, I don't say that in a bad way, but right, it can affect so much about a deal. But because it can affect so much about a deal, we want some way to account for it. You know, it's just a hugely important aspect of real estate because most of what we do is levered in some way. The flip side of that is that aggressive, or to put it more lightly, favorable financing can really obscure the underlying quality of a particular deal, right? I've seen deals that have 10-year% IO at 2.7%. Sorry, yeah, 7 or 10-year debt at IO at 2.7% rate. I mean, besides being hugely jealous of those terms and terms that I certainly can't have access to, you know, I realize this isn't necessarily a good thing. So do you want to use debt to maximize your returns? Yes. Can debt, though, in doing so, be used to take something which may not be fundamentally sound or may not be that great of investment and make it look like it's a better investment? Absolutely. And so what we want to do is we want to have some sort of metric that accounts for debt, but that isolates a lot of the noise of debt. So amortization period, your rate, whether it's IO or not, you know, tweaking those numbers, your debt load can go way up, way down, and thus your returns can go way up or way down. So what is something that, and let me say, the reason why, say you have an operator that's able to get access to amazing debt terms. They're big, they're experienced, banks trust them. Great, that's a great thing. But now think about, is that a result of the current economic environment, right? Yes, that's a macro trend that affects financing. Periods of liquidity, when that dries up, favorable financing like that may not be available. As interest rates creep up or other events happens, you know, these debt products are always changing. And right now we're in a very, very favorable environment. So, but you say, what's wrong with that? Like, why wouldn't we want to use that? Well, I think where we might get into trouble is that the valuation that an operator is paying for a product that they're using that kind of really favorable debt on, their valuation can be, pretty premium. They're paying a high value for that because their debt's going to help them get to, again, backing into their return. It's going to help it get to that 15% IRR. 5 years from now, whatever the business plan is, 7, is the next buyer going to have access to favorable terms like that? Probably not, right? We're living in pretty special times. So if the next buyer is not going to have access to that tool, that type of debt, they're not going to be able to pay quite the premium that your current operator did, right? So, debt is good, useful, but be careful that it's not doing too much of the heavy lifting as far as the returns of that project, and for that the fundamentals of the project itself are going to be able to translate across buyers, across interest rate environments and whatnot. So we want a margin of safety. We want to know what the deal can support at a foundational level. So how do we identify that? Stabilized debt yield is my preferred. And again, I don't want to imply that with these two numbers, you can know everything about a deal and these are the only things to rely on. There's lots of, things that you want to dig into and understand, but compared to what's out there, I find these numbers to be much more useful. So stabilized debt yield is very simple. Your stabilized NOI, this is the number that was in the numerator of the return on cost. You've already got that, divided by the loan amount. Okay, seems pretty simple. What is this telling us? What does this number represent? Well, think about it from a lender's perspective. It really is, if the bank has to take ownership of the property, it's the bank's return on that property, or really it's the bank's cash on cash return. Okay, say the bank had to take it, it's the bank's cash on cash return, right? Because their investment into it is the original loan amount, and what it's earning is that stabilized NOI. Now, I'm not asking you to think for the bank, but I think it'd be illustrative to think like the bank, okay? And this is really answering the question of how burdensome the debt load is to the property's earnings, okay? So let's look at an example. And again, these are both very knowable things, at least by my definitions, and at least compared to the other speculative numbers in other metrics. So as we were looking at before, we got our NOI at the top, we got the total loan amount for that previous project we were looking at. That's about an 8.53% debt yield. So that means if the bank had to take it over, in about 11 and a half years, it'd be completely paid off. Or to think about another way, if the bank took it over, that's an 8.5% cash on cash return, which, as we all know, that's a pretty good cash on cash return in today's market. And it's useful to determine your ability to finance future loans, right? So this number is independent of interest only periods. It's independent of interest rates. It's independent of the amortization period. So no matter what the interest rate or economic environment is of the property when it's time to sell or when it's time to refinance, you have some sense of how burdensome the debt is on this property that is earning $1.7 million a year. Okay, it's a number that represents the burden of that debt. Again, it's not the debt payments; it's the total debt itself, right? We really cut with a knife through all the noise around financing and leverage. Leverage isn't just about LTV. There's so much more that goes into it. Really cuts through all that noise and gives you one number that represents this. And so, I think, let's look at targets here. 10% plus on your debt yield is great. Also very, very hard to find these days. Anything 8.5% or above is pretty solid, right? If you put yourself in the mindset of a lender, again, not asking you to think for your bank, but if you put banks have decades and centuries of evaluating risk. And this is something that they use a lot internally. So it's super useful. So if you put yourself in their mindset, if you're looking at investing in something that if you had to assume ownership of it, gave you a return like this, that's a pretty good return, right? It gives you a sense of, okay, that this is something that even if we had to take it on or change the financing for, it's going to be pretty easy to always get debt for something that is performing to this level. Okay. Now it can definitely fluctuate. and, you know, depending on the basis, be a lot narrow, but the whole point of both that number and also the return on cost outside of the math, outside of the mathematical jargon, is just to recognize the flaws in your future projections and understand that we want to rely most on what we can know today versus what we think we might know in 3 to 5 years from now, which is the same thing as saying what we cannot possibly know. So hope you took that from today's talk and now have two new tools in your toolbox that you can use to rely on to be a little more quantifiable with that type of analysis. And if you want to find out more about Flywheel, you can go there. There's my website. But otherwise, would love to open it up to questions and comments even too.
Awesome, Ryan. Thank you. That was super informative. And we definitely have some questions here.
Right.
So one of the questions is, should debt service coverage ratio be considered when looking at a debt yield percentage?
So the DSCR that's a number that is based on your debt payments. Debt payments are calculated using all parts of debt, like your IO period, amortization, et cetera. So you definitely have to look at DSCR, but there's a bare minimum there that a lot of deals can meet, and they can meet it by getting really aggressive financing, right? So the debt yield is meant to isolate the fundamentals without having to, by ignoring what I'll say trickery, but by ignoring what can be manipulated with really aggressive financing. So they're really two different types of measures. And I would say that debt yield is the one that is more reliable and less sensitive to current economic climates and just where we are in this point of time, right? Because we're trying to limit the time variability of these calculations. So debt yield does that much, much better than DSCR, which is very time dependent.
Okay. In debt yield, do you take into account interest payments? And then do you also take into account the NOI?
So debt yield, yes, the top number is your NOI. Bottom number is the loan amount. Okay, so that does not take into account interest payments versus principal payments, anything like that. It's just what you are on the hook for, what money the bank is lending you, the total loan amount is what's on the denominator.
Okay, lots of questions here. So for the UYOC calculation, I don't know how you're saying that or how you're pronouncing it. Do you include financing cost in the denominator for duration of renovation / hold?
So financing, so, you know, say you had a loan that had you're paying interest only on the loan. So I would say no, the financing costs, let me separate it out, right? So a lot of times you can go in with bridge financing that's going to give you more of a loan to cost, like 80% of loan to cost, because in value add projects, you may be putting a lot of money in the form of CapEx, right? So your purchase price is a small percent of your overall outlay, or your down payment is a small percent. You're also having to come to the table with a lot of liquidity for that CapEx. So there's different loan products that will help you get more of that up front versus having to come to the table with it yourself. So if it's part of that, then no, that's not part of the return on cost. If you have, you know, some maybe a second lien type loan option that you're using to finance your CapEx, then yes, I would say that is your part of your cost of renovations. And so I would include that in your renovation costs.
Thank you, Ryan. How does your group best determine what market cap to use? Sales comparables, example, Class B, 1980s, build value add, and Class A area CBD.
All of the above. So definitely it's very submarket / neighborhood dependent. It's size dependent. It's class of property dependent. It's age dependent, right? You really want to narrow it down. And, you know, obviously you're not going to find 5 properties that match the 20 specific characteristics of your property, but you want to get really, really close and have a really good sense of again, you're trying to evaluate what would my property or my product, what would it get on the market today? So go find the closest that you can to that. Sometimes we have to not fudge, but sometimes we might have a pretty good comp, but it's newer or has amenities. And then we have another property over here, which is a pretty good comp, but it's smaller square footage, right? And so we're there's a range here, but when you've got a couple of them, you're able to draw a pretty clean line through the center and come up with a really, really accurate comp.
Awesome. How do you take into account time value of money comparing a 3-year versus 10-year project?
So these metrics don't take that into account on purpose. That's a feature, not a bug, because my perspective is that beyond the fundamentals of the property and your comfort as an investor with the sponsorship team, the rest is macro risk and macro trends that the market is going to apply to the property, completely outside of anybody's control. Okay. So why would I try to model that time value when it's just completely outside my control, and it's also going to be applied to any other investment I might be doing? Okay. Right. So it's not specific to me. So if I get into a deal that by these numbers looks good and I'm comfortable with, and the market tanks, yeah, my returns are going to suffer. Absolutely. But the point is, so will everybody else's. So you really just want to try to isolate that out. You are always at the whims of the market, of the macro market, and you're really trying to identify what is the specific qualities and characteristics of one particular investment. And then, so from that, you're not looking to say, okay, well, based on that, 5-10 years from now, I'm going to be at a 12.8 IRR or average annual return, or anything like that. You just have to know that you are getting into real estate because it has good downside protection. It has steady, consistent long-term returns. This is historically, by decades and decades of history, right? If you have that long-term mindset, that's why you get into real estate. It's a great diversification tool. It has good cash flow while you hold on to the asset. That's why you should get into real estate, not because you're trying to model out 7 to 10 year time value of money returns and compare that to what you might be able to get in stock market or in Bitcoin or things like that, right?
Okay, a question here. Would you be willing to provide the decks for people who want to look at them once the presentation is over?
Absolutely, yes. I'll send that to you and you can distribute.
Awesome. Going back to the last question on market cap, what about looking at our going in cap rate? How does that compare? We are currently under contract for a deal in Uptown Charlotte, buying at a 4.25 cap. Would this be considered market, even though we know it's slightly compressed?
Well, it sounds like it's not market if you're saying it's compressed. So cap rates are really, I won't say wholly useless, but I'll say much less useful for value add projects than stabilized, right? As far as a measure of am I getting a good deal or not? If you're looking at value add, cap rates aren't useful. Return on cost is the thing that you need to be looking at. If it is stabilized, and if it is, if you're going in cap rate is pretty much represents everything about the project, then and you compared it to previous sales in that area for that type of asset, and you're paying a slightly higher premium, then you're not making a new market. You just might be paying a little bit more for that asset. You have a willingness to pay for that asset. Now, I don't think that's a bad thing, but it does identify what are you relying on, right? It forces you to answer that question. Is it that you have a stronger conviction about multifamily as an asset class than other people? Is it that you have some intimate knowledge of Charlotte that other people do not, that make you, that gives you comfort that is an investment that'll pay off over the long term, whereas other people do not, right? What is your informational advantage that gives you the proper investment rationale and the investment thesis to pay more for that particular asset? So, it sounds like, again, if we're comparing apples to apples, stabilized to stabilized, if you are going in at a lower cap rate, thus, implies you're paying more for it, then you need to be asking yourself that question as a sponsorship team. If it is a value add business plan, put that cap rate aside. You can't compare just because another value add property sold down the street at a 4.5 cap rate and you're buying this at a 4.25, it's also value add. You can't compare value add like that. There's so much variability within what you're going to do. What does value add mean to you and how much you're going to spend to get there? You can't compare apples to apples. You really need to revert to return on cost and look at that metric much more closely.
Thank you. It looks like we have time for maybe 2 more questions. One is, what is debt I/O? I think that's
so IO, interest only periods, right? So interest only payments. A lot of loans will have 1 year, 3 years of interest only payments. So your debt service, your debt payments are much lower because you're not paying down the principal. But you don't really want to rely on that for returns, right? That basically means your deal only works because you are not paying down the principal. And so that's one way that it might hide that the deal isn't producing enough cash to just return proper cash on cash returns in a more traditional way or more reliable way, and that they're relying on super low debt service payments.
all right. Last question before we wrap up. Outside of debt yield and unlevered yield, what is the most important item that you look for in deals in terms of risk profile?
I would say the higher level, but still within deal specific. So that would be the team and the market, right? My comfort with both of those things. A rising tide lifts all boats, and if you have a good captain on board, then even in choppy waters, I'm really stretching this metaphor. Sorry, I don't know where it came from. You're going to be okay, right? So you have these numbers, these very quantifiable numbers that you can use in a very analytical way to look at risk and return premiums. But then you also, you still have to look at who is running your deal, where those deals are happening. Because if you can get it in an area that has good supports, good long-term support, it buys you a lot of margin of error. So I would say that those are the other 2 things to make sure that you're not losing sight of.
Awesome. Thank you, Ryan. While I was thinking too, there's probably more questions. So how can people get a hold of you? Do you have your contact info on Flywheel Equity? Okay, great.
Go to the site. It's also, my email is also pretty easy. It's Ryan at this domain, ryan@flywheeleq.com. I know we were talking about that deal in Charlotte. If you want to shoot an email to me, I'll be happy to look over and at least give you another perspective if that's what you're looking for. 2 minds are better than one, but always happy to look over this kind of stuff with other operators and help out where I can.
Ryan, this was super informative. I appreciate your time, and I know others do too. Lots of great questions, and thanks for joining, everyone. Have a good evening.
Thanks, Brittany.
Yes, take care.